Hello everyone, my name is Mark Jarvis and I'm a visiting professor at Manchester Met University in the Accounting, Finance and Banking department. Well, firstly, a belated Happy New Year. This is the latest webinar in the series, which are recorded monthly and focus on the economy and significant changes to the world of business with a focus on the finance market. Normally, I would start with a backdrop of COVID-19, but I think we are all too familiar with this right now. So I will delve straight into the economy. Some good news, but not all, as the Bank of England governor warns that the UK economy is facing its darkest hour due to the latest COVID-19 lockdown, which will delay the recovery. This has echoed warnings from Chancellor Rishi Sunak that the economy is going to get worse before it gets better. Bailey said the UK would bounce back, but only after the lockdown had ended and concerns about the spread of the virus had receded. The UK is, of course, in a very difficult period at the moment, and there's no question that it's going to delay that recovery trajectory. We do expect that the shape of the recovery, while delayed, would broadly follow the forecast made by the bank's Monetary Policy Committee, the MPC, last November, although the unemployment rate, which was previously expected to peak at around 7 to 8% in the summer, could be a little bit lower after the government extended its job protection scheme. The MPC meets early next month to discuss how the central bank can help protect the economy during the lockdown, including whether interest rates should be cut to below zero. A move that could ease borrowing costs on households and businesses, but there has been differing views on this as a tool. Bailey has said he was skeptical that a cut from the current already all-time low of 0.1% would be painless, arguing it could make the situation worse, noting that there were, I think, lots of issues with cutting interest rates into that negative territory, and such a move could hurt banks. On the other hand, Silvano Tenreo, the external member of the Bank of England's Monetary Policy Committee, said that negative interest rates could be good for economic growth in the UK and could aid its recovery from COVID-19. Anyway, the bank is currently examining the feasibility of negative interest rates. The MPC would then face a separate decision over whether they are the right tool to use during its meetings. Officials at the Bank of England fear that negative rates will trigger a flight of savings, depleting the reserves of commercial banks and forcing them to cut back lending. So one to watch for sure. Okay, let's have a little look at the economy. And if I may, I'll share a screenshot for a second. The move forward in our economy needs skilled labour. And moving to our post here on Brexit economy, according to the newly released Deloitte CFO survey chart, 66%, as you can see here, of chief financial CFOs at some of the UK's largest companies expect the new points-based immigration system to be a drag on the UK. As part of the UK's exit from the European Union, it's implemented a points-based system of immigration, I guess inspired by that in Australia. As described on the government's website, under the system, anyone coming to the UK for work must meet a specific set of requirements for which they will score points. Visas are then awarded to those who gain enough points. While the government says this provides flexible arrangements for UK employers to recruit skilled workers from around the world, CFOs clearly remain sceptical about the positive effects it will have on the UK's long-term economic growth. So perhaps another one to watch. Okay, so let's turn a little bit to the broader world, and we can look at, for a second, the Asian stocks, which have started strong. I think ever since Joe Biden's win, Asian stock markets have rallied. But even before the US elections, indices on the continent had taken new corona outbreaks, for example, in Japan, South Korea, in its stride. Talk of a new lockdown in Tokyo, however, has the Nikkei losing some gains. Strong gains since the summer have mirrored the situation in the US, where infections continue to spread after a short slowdown, but stock markets didn't react to the virus reprise in the same way they did when the virus emerged in early 2020. Hong Kong, which battled the spike in cases in July and is, of course, also dealing with the increased oversight from China, saw markets recover the least as a result. In China, where case numbers have remained most stable, markets have been back above January levels since early July, but lag behind the Kospi's and the Nikkei's gains. However, across to the US, an unusual trend is that the trade deficit has widened in the 2020 recession. So when things turned sour for the US economy, the country's trade deficit, i.e. the difference between exports and imports, usually narrows. As consumers' spending goes down during economic downturns, so do imports. Goods directly or indirectly targeted consumers. And as Americans tend to travel less during recessions, service imports, which is how tourist spending abroad is accounted for, also fail. At the same time, loose monetary policy tends to result in a relatively weak dollar, in turn boosting exports and attracting foreign tourists. If I may, I'll just move to a chart here just to explain that point. As this chart illustrates, things are different this time. Despite the COVID pandemic having brought on the deepest recession on record, along with an unprecedented job crisis, the current downturn did not result in the usual narrowing of the US trade deficit. Quite the opposite, in fact. Between February, the official beginning of the recession, and October, the trade deficit widened by more than 70%. There are several possible explanations for this unusual trend, with the most obvious being the extensive stimulus package that has bolstered consumer spending, hence imports during the crisis. Another hypothesis is a shift of consumer spending from domestic services, i.e. restaurants, bars, movies, theatres, which were all closed, to goods during lockdown, resulting in a larger share of imports in total consuming spending. At the same time, exports have yet to recover from a sharp decline at the onset of the pandemic, partly due to weaker consumer demand around the world, but partly due to trade tensions with China, and again, also some weaker aircraft exports in the US. So here I am talking about the global economy, but has globalization passed its peak? After decades of growth for the world trade, global tourism and international cooperation, globalization hit a couple of roadblocks in recent years as the re-emergence, I would say, of nationalism and protectionism has undone some of the progress made in the past. After global trade slowed significantly in 2019, due in large part to, I think, trade tensions between the United States and China. The COVID-19 pandemic is expected to be an unprecedented fall in world trade. According to estimates from the WTO, world merchandise trade is set to plummet between 13 and 32% in 2020. So, if I may, I will just share one more chart with you. And here you can see this is World Bank data, and it shows global trade volume, measured here as a percentage of global GDP. And it's been relatively stagnant, I would say, for years, after several decades of uninterrupted growth. Following the trade decline caused by the global finance crisis in 2009, world trade never returned to its previous growth trajectory. And many are expecting a similar long-term effect of the current crisis. Having reminded many companies of the vulnerabilities of global supply chains, both the pandemic and the trade war between the US and China, could lead companies towards a more domestic approach to production and sourcing and supply chains, which might result in a sustained reduction of global trade. So, looking to the future, most people agree that COVID-19 has brought about many changes that were either expected, but not just now, or perhaps were not even contemplated. Referring once again to Deloitte's CFO study, I will share a slide with you, which really looks at some macro changes in the UK, some more surprising than others. Obviously, 97% increase here in flexible home working is expected. A big expectation of an increase in taxation in corporate and individual taxation. Diversification and nearshoring of supply chains. I think that's a very important thing to note, because the supply chain model that we've been used to of just-in-time sourcing wherever hasn't worked in COVID-19, and I think a number of companies will begin to look at that as something they need to fix. Investment in new technology, clearly important. What I was surprised about is the size and role of government in the economy, with many of the CFOs expecting a significant increase in the size and role of government in the economy, and indeed regulation of the corporate sector. Labour costs increasing, I think that's expected due to the Brexit issues, and of course high-skilled immigration from outside the EU is expected, given that we will have to broaden, as we talked about earlier, that points-based visa application. What we're seeing here, of course, is a significant decrease in relationships with the EU, but clearly that's expected. So I wanted to touch on number one here, which is the flexible working, the remote work. It's proved to be an effective replacement for many companies' employees throughout the year, whilst the absence of in-person collaboration has been tough to recreate. Workflow and the organization structures of workers has adapted well, I think, for a majority of industries. While some companies are itching to get their workforce back to the office, others are making decisions now that could permanently move a large chunk of employees to remote work for the foreseeable future. New data shows how a substantial percentage of company departments plan to remain working remotely 5 years from now. According to a report released by Upwork, which I will just share with you here, nearly 23% of work teams and departments in the US plan to continue working remotely 5 years from now. That's an increase of over 10 percentage points compared to the number working remotely before pandemic restrictions. Roughly 63% of teams and departments plan to return to a fully remote work mode, while 15% said they'll work partially remotely in the next 5 years, an increase of nearly 6 percentage points from before the pandemic. Overall, research within some companies shows remote work has evolved to become an equal, if not better, alternative to in-office work in 2020. Several months of fine-tuning organizational structures within a remote setting has led to a new normal in terms of accomplishing tasks and projects. According to Upwork, freelance work is also a burgeoning trend as more people feel drawn to a more permanent remote work lifestyle. Since many companies are now more accustomed to the tools and infrastructure needed to work remotely, freelancers have become a more appealing option for many. So now with the vaccine being rolled out and more than 2.2 million in the UK having been vaccinated on Sunday, the 10th of January, we might be thinking about a vacation. Seems a distant memory, but while few industries have been spared by the impact of the COVID-19 pandemic, even fewer have been hit as hard as the tourism sector. As 2020 drew to a close with severe limitations to travel still in place, the World Tourism Organization, UNWTO, expects international arrivals to have declined by 70 to 75% compared to the previous year. That equates to a decline of around 1 billion international arrivals, bringing the industry back to 1990 levels. Prior to the coronavirus outbreak, the global tourism sector had seen almost uninterrupted growth for decades. Since 1980, the number of international arrivals skyrocketed from 277 million to nearly 1.5 billion in 2019. Looking ahead, most experts don't expect a full recovery in 2021, which started off with many countries still battling the second wave of the pandemic. And again, according to UNWTO's estimates, it will take the industry between 2.5 and 4 years to return to pre-pandemic levels of international tourist arrivals. So looking at COVID-19's crushing impact on international tourism, World Tourism Day is observed each year on September 27 to, as it says, foster awareness among the international community of the importance of tourism on many, many countries. So this year's edition of World Tourism is meant to celebrate the role that tourism plays. But of course, the official theme was overshadowed by the COVID-19 pandemic. And if I can show a couple of charts here for a second. This is the impact that you will see. And you will see this is how the UN's WTO has seen the impact on international tourists. The most positive of is that restrictions will be lifted in July, even under this scenario. We do think this will continue to be a very, very distressed market, and looking how things were in the first 10 months of 2020. That's the latest data. The outcome is clearly a very poor situation. As the following chart shows, international tourist arrivals from January through to October were down 72% around the world compared to 2019, with many countries still battling with high case numbers at the start of 2021, of course, and reanimating the ailing tourism sector will likely take years. As millions of people continue to fear for their livelihood, especially in regions heavily dependent on the influx of international tourists. Okay, so finally, I wanted to touch on one more thing. And for this month, we'll have a look at one of the big news stories today, and that is cryptocurrency. I think this is a big story, as we all know. As the hype increasingly turns to reality, the Bitcoin's rise flags opportunities to treasury teams around new central bank digital currencies, CBDCs, and payment opportunities based on blockchain. The digital currency has soared 8-fold since last March, with recent valuations topping $40,000 a coin compared to $5,000 9 months ago. It's a rapid rise from its 2009 launch as a decentralized democratic alternative to traditional tender, ungoverned by any state and operating on a peer-to-peer network. The original idea that Bitcoin would be perceived as a digital gold and trusted store of value and haven in uncertain time is becoming a reality. Fearful that central bank strategies are hurting the value of their currencies and inflation is coming, investors are beginning to see Bitcoin as a legitimate source of diversification and hedge against inflation. Bitcoin itself does not offer anything to corporate treasury teams at this stage of its evolution, but it will begin to appear in treasury in important ways, predicts Hayden Jones, a director and a senior blockchain market specialist at PwC. For example, he notes that the institutional interest in gaining exposure to Bitcoin as an asset class, as mirrored in its price, could lead to treasury teams receiving more queries around the currency. I think treasury teams may start receiving queries related to the execution of payments for the purchase of Bitcoin. Other experts flag future developments like more companies, some sitting on significant cash piles, seeking to hedge their cash position using Bitcoin in a move away from traditional inflation hedging allocations like gold and inflation-linked bonds. Companies with a young customer base who understand and probably hold Bitcoin will be first out of the starting blocks. Although most Bitcoins are held as an investment and not used to pay bills, it's starting to change. Last October, payment company PayPal and its Venmo subsidiary started storing Bitcoin with a view towards accepting it as a payment, making its use as a form of money more feasible. Elsewhere, smaller businesses are beginning to use Bitcoin in international trade, particularly in countries where dollars are scarce or the local currency is unstable. Monthly cryptocurrency transfers to and from Africa of under $10,000, typically made by individuals and small businesses, have more than doubled over the year, according to data from US blockchain research firm Chainalysis. And I won't get off topic here, but maybe worth reading Chainalysis' report on money laundering and cryptocurrency. So the rise of Bitcoin has paved the way for, as I said, central bank digital currencies, CBDCs, and so-called stable coins, cryptocurrencies that attempt to peg their market value to some external reference like the UK dollar or to a commodity price such as gold. Companies will increasingly start using CBDCs and stablecoins, and both will soon offer much to treasury teams in terms of payment. Momentum is also coming from the UK. Chancellor Rishi Sunak, who recently highlighted the opportunity for CBDCs last November, has pledged that the UK would lead the global conversation on these new technologies. Elsewhere, the government has just issued a consultation on the use of stablecoins on the basis that they could lead to faster, cheaper payments, making it easier for people to pay for things or store their money. Blockchain technology combines the ability to store value, record that value in a ledger, and securely move it from one person to another, as well as attach nested conditions related to the contract. A recent PwC report on the economic impact of blockchain argues that it has the potential to boost the global GDP by $1.76 trillion by 2030. Further in this is an interesting point when we're looking at Bitcoin's correlation with gold. And one of our last slides here is Bitcoin is now more closely tied to safe haven gold than ever, possibly bringing the cryptocurrency great resilience to risk aversion in the traditional markets. The 60-day correlation between the two assets is hovering at a record high around 0.5, according to Coinmetrics data. The positive correlation has strengthened sharply since the beginning of July, as the US dollar has started taking a beating against other major currencies. The strengthening of the positive correlation appears to validate the popular narrative that Bitcoin is a store of value and a haven asset. Some investors believe it is a sound money like gold. As such, the cryptocurrency's sensitivity to movements in risk assets, mainly equities, could lessen. As already mentioned, the UK Chancellor has given some tacit positive sign to crypto assets and the current regulatory landscape. As such, the Bank of England noted that there's been rapid change over recent years in this sector, accelerated further by the impact of COVID-19. Crypto assets offering a new way to transact, invest and store has been part of this trend and could play an increasingly important role in the future. However, as will always be the case with rapidly changing technology landscape, they also present new challenges and risk. At present, a large proportion of crypto assets fall outside or are likely to fall outside the regulatory perimeter. This means they may not be subject to the same consumer protection and exposes consumers to potential harms. And depending on the prevalence and value transfer, could pose financial stability and consumer risks. In light of this and reflecting the pace of the change, the Treasury's March 2020 budget allowed two measures as part of the UK's response to crypto assets. That is, consulting on bringing certain crypto assets into the scope of financial promotions and the regulation to enhance consumer protection, and consulting on the broader regulatory approach to crypto assets, including new challenges from so-called stablecoins. And finally, I do think regulators are sharpening their focus on Bitcoin and its use on the international financial system after the value of the digital currency raced higher in a volatile rally that fed concerns over its lack of robust oversight by financial watchdogs. The UK's Financial Conduct Authority and the President of the ECB highlighted the need for more stringent regulatory scrutiny of currencies this week. The ECB noted the extreme volatility and criminal activities often associated with the market. ECB chairman didn't allude more on that, but said that at a conference on Wednesday that Bitcoin was a highly speculative asset which has conducted some funny business. So we'll have to see what that means, what the detail is behind that. As you can see, as this picture shows in Hong Kong, when Bitcoin's on a bus, is this a time to buy or is this a time to sell? In this regards, comments follow a grimly worded warning from the UK's regulator, which reiterated to consumers this week that anyone dabbling in Bitcoin schemes should be prepared to lose all their money. Today, Bitcoin is at 39,707 US dollars. So you need to make your own decision. But whatever it is, cryptocurrencies are not going away. Thank you very much for your attention. And once again, Happy New Year, everybody.